CBA is predicting a 30% property crash. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. I have my Stein in hand, and I thought we'd have a look at an article that was been shared to me by several viewers. A lot of you are very interested in this potential property price crash predicted by CBA and their latest data. Now, it looks like Yahoo Finance were the first to break the story on the 13th of May, while other news outlets have followed up since then. So I thought we'd go through Yahoo first, look at some others, and then look at the actual reporting from CBA, because this has come out in their 2020 first half reporting. So let's have a look. Home prices will tumble 32% over a prolonged downturn period, the Commonwealth Bank has warned. Now, home prices, for those of you that haven't been watching anything, have steadily increased, particularly since 2000. You can see just the growth there. The blue line's Melbourne. Then you've got Hobart, which really surprised me, because the last time I went down to Tasmania was back when I was at university, and I remember talking to some of the locals there, how cheap their houses were, how they could get a house right near the city, right near Hobart or right near Lonnie for a couple $100,000, and they were beautiful little houses. Of course, you needed to have a fireplace, and as a Queenslander, I'd never used a fireplace. But then you've got, the average of capital cities. You've got Sydney as well, Canberra, Brisbane, we're up there. So you can't really question the fact that we have a property bubble here in Australia. A significant portion of the wealth of our nation has been diverted into property. We're property mad. We've got TV shows encouraging people about property. And then, I've been talking about this for a couple of, property and business and construction really for about a year now on my channel. And I go back to some of the earlier predictions, and people would go, property will, always goes up, always goes up. It's only fringe people who dare to even predict a 20% decline or a 30% decline. Now we have one of the big four predicting a 30% potential decline. And it's to do with a prolonged downturn, everyone. We've got the RBA, we've got everyone hoping that we're going to have a sharp V-shaped recovery where the economy will shoot right back up. Bounce off, potential depression. Even though tourism is down, even though demand for our exports is going to decrease. We've seen, even though there's what do you call it, a trade spat with China, our beef exports now are going to decrease. And so a viewer sent me some information about the current beef exports. So I discussed this in a previous video based on all the data. China, as I suspected, has become a more important destination for our exports. They're still not number one, but it's still going to make a dent. This is the thing. So, would you say now that these predictions coming potentially from the Big Four are a sign that it is now entering the mainstream? And if we start seeing more and more of this, it may drop this, it may drop this, do you think the property bulls can just, FOMO it away? Do you think they can? So let's have a look. In Sydney, where the median house price is $889,000, that fall would wipe $284,000 from the median house value by March 2023. And this is the time frame they're saying. Not instantly. None of these things happen instantly. If we're discussing a potential property crash, if we're actually at the first stages of a depression, and you're watching the stock market go, up, down, every little tiny thing. The Great Depression, or the stock market crash then, lasted over a year. It took a while. It took a long time. Slow and steady erosion of confidence in the market. So, 2023, think about it. What's your loan? If you took a 30% cut, if you've got a home loan on the value of your property, where would you sit then? How many people, and here's the real interesting question, how many people would end up being in negative equity? And then if you're in negative equity, the wealth effect is going to get decimated. So all that extra frivolous spending that people do, because I know some people will say, people will just sit on their houses, and yes, you're right, they will. the investment properties that may have to flog off. That'll be a whole flood of them entering the market. But also the wealth effect. You'll get the negative wealth effect. People will be negative value. So you think discretionary spending will increase in that environment? I'd bet a carton that it wouldn't. So across Australia, where the median price is $555,000, a correction of this magnitude would wipe $177 from the median home value. However, CommBank is also predicting an 11% fall would occur between 2020 and 2022. The stark analysis came as CommBank announced its quarterly trading update for the March 2020 quarter. Okay, so it was a quarterly update, not a half update. My apologies. The bank said the figures were part in due to higher unemployment and underemployment, and pay cuts as well as due to current prices. The country's largest bank has also set aside $1.5 billion to cover losses caused by the recession, based on, here we go, we're starting to hear the word recession, based on its best case that Australia will suffer a 6% economic downturn over 2020. So this is their best case scenario, guys. This is the CBA's best case. What would the worst one be? The bank predicts unemployment will peak at 10%, but average 8%. Now remember, these are ABS figures, so if you want to go with the Roy Morgan figures, double them. Because right now they're saying, Roy Morgan's saying our unemployment is around that. Underemployment and unemployment is about 25% of the workforce. That's what they're telling us from their survey data. That's the number that I'm most concerned about, because underemployment, that affects your ability to service, your home loans, that affects your ability to have discretionary spending, that affects the flow on to the rest of the economy. But the bank believes a recovery will be rapid, with GDP surging 6% in 2021 and another 3% in 2022. Okay? Why? We'll look at their document and see why they're predicting that. Are they just saying it'll happen because it'll bounce, there'll be new opportunities and will shoot up? Are they just doing, TA on the economy? CommBank revealed it had approved repayment deferrals on 144,000 home loans valued at $50 billion. That's a bit striking, isn't it? I've been bringing up this chart for a while. It's come from the Reserve Bank, just looking at the change in arrears rates. What would happen there if we added another 144,000 mortgages? Because deferrals, they're just in arrears with the bank's permission, aren't they? And also approved deferrals for 71,000 business loans worth $15.2 billion. We're in crazy times, aren't we? We really are. And the bank had also received 1 million calls for assistance and 4 million visits to its website, as millions of Australians are being forced out of work, had their hours cut, or suffered pay cuts. So, some drastic predictions by the CommBank. So now potentially a 30% property sector cut is in the mainstream. Would you agree? So let's have a look at news.com's take on this. Australia's biggest lender has forecast house prices could tumble by up to 30% in the wake of the pandemic, and Sydney and Melbourne could be hardest hit. Well, that's no surprise. Sydney and Melbourne, of course, will be hardest hit. Hopefully Hobart, too, will take a bit of a battering. The predictions could wipe up to $300,000 from a $1 million Sydney home. All four of the nation's big banks are now predicting double-digit falls in house prices as unemployment rises sharply. Westpac is forecasting a 20% fall. But the Commonwealth Bank has now emerged from the pack with a grim outlook that's even more alarming. The Commonwealth Bank's chief executive, Matt Comyn, has described a 30% prediction as a worst-case scenario. We need to be prudent and consider a realistic downturn, but also plan for a worst-case scenario. And that would see a sustained increase in unemployment, he said. Australia's median house price hit 809,000 in December quarter. That's insane, guys. That really is insane. Now, for those of you overseas, a standard specky Australian house, a little brick veneer place, is nothing special. They can build them pretty damn cheap, couple hundred, 300 grand. And some of these things go for insane amounts. Insane amounts. Under the CBA scenario, the value of that home would crash by $242,000 to just $566. But even under the more benign prediction of an 11% fall in house prices, that could be an $80,000 fall. Well, it happens, guys. I mean, it's easy come, easy go. It's easy come, easy go. This is why when I see all these property spruikers talking about their system, how they've, made a fortune, how they can teach you their system, you've got to realize everyone's an expert in a market that's constantly going up. We'll see how these experts fare now that we're looking at a potential tumble. But we'll see, because everyone's a genius. Everyone's a genius. So Commonwealth Bank has also revealed 200,000 borrowers have requested a repayment holiday, that they've lost jobs and experienced pandemic distress. The CEO admits it was very difficult to forecast how many people who have lost their jobs as a result of the pandemic lockdowns will no longer be able to pay their loans and be forced to sell up. Here we go. This is the thing. This is why, we're getting all these spruikers saying, it's real estate's back, the Chinese buyers are back because of search results. Search isn't buying. It isn't market activity. It's very easy to do. People can be searching for real estate in bed. Perhaps people are just putting their feelers out there because they're expecting a crash in 6 months. You tend to take a while looking for property. What do you reckon, everyone? Do you think that's what's spurring all these bulls on? We've entered into a 6-month repayment deferral at the 3-month mark. We will communicate with our customers to understand what their current economic circumstances are. And clearly for those who are able to return to work, who can start repaying their mortgage, we will encourage them to do so, he told ABC TV's The Business. But it's possible that some customers within the population will need ongoing support from September. The worst-case scenario of a 32% drop in house prices assumed a prolonged 2-year recession with unemployment at 9%. What's the probability of that case? Do they give us probabilities of these things? I never see, this worst-case scenario of 32% drop has an 18% probability. They never say that, do they? Maybe someone who follows this a bit closely or who works in the industry could let us know if they're watching. Westpac Chief Executive Peter King warned customers that prices could plunge earlier this month. House prices are expected to fall through the remainder of 2020, reversing the recent recoveries, particularly in Sydney and Melbourne. He said, so if we're having prices going down, then they go up, and then they go down again. What's that called, everyone? Dead cat bounce. We've been talking about this in previous videos, haven't we? Unfortunately, ongoing international travel restrictions will continue to flatten inbound tourism and impact foreign student arrivals. So Sydney's median house price increased from $864,000 to $1 million last year. I mean, that's just crazy for what these things are, for what these houses are. You're just paying for the land pretty much. So let's have a look at the quarterly report from CBA and have a look at where they're making these predictions. I mean, here you go. I mean, this is how they're supporting their customers and businesses. They love their customers. Progress in becoming a simpler, better bank. So they're divesting of the 55% of Colonial First Stake. Oh, there you go. First State. And we'll scroll down here, and I will link to this if you would like to go through. I mean, here's their provisioning. 1.5 billion pandemic overlay provisioning based on bottom-up analysis and top-down judgment. So, and here we go. Scenarios and credit RWA migration outcomes. A range of scenarios considered. So, macroeconomic assumptions reflect forward-looking scenarios updated for current assessment of the impact of the pandemic. Output considered deterioration of customer credit risk scores and increases to losses given default as value of security declines. Just think about that. Housing, key drivers, unemployment, underemployment, changes to income and house prices. Non-housing key drivers, range of increasing stress related to industries most impacted by the pandemic. Uncertainty exists regarding duration and severity of the pandemic, associated disruption to economic and extent of future policy responses. There you go. I mean, that's the thing. We've got an element of state risk now. If you're in business, you may need to prepare for this. So we can see here a prolonged downturn. They're predicting 2020, 7.1% fall of GDP. So there's two here. Okay, they're only reporting on the downturn. So here's downturn, 6% down, 6% up, 6% up, 20, 21, 22. Now, prolonged downturn, they're saying we'll have, and we'll do that in a different color. They're saying we'll have, green, 7.1% fall this year, 0.8% fall next year, and then just a recovery of 2.3%. The average, or the unemployment rate, they're saying we'll hit 8.25 today, 8% 21, 6.5% in 22 in the downturn, prolonged downturn, 9%, 8.5%, and 6.5%. The housing price index fall, they're predicting either 11% for just the downturn or 32% for a prolonged one. So there you go, guys. There you go. So this just shows you what their predictions are based on, what unemployment will be, and what GDP growth is looking like. We'll have to see. Which do you think is more likely? A downturn or a prolonged downturn? Why? Why is this going back up in 2021? Perhaps they're thinking the markets will return. Maybe it will. Maybe it will. As always, let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and you want to support us, there are a few ways you can. You can join us on YouTube or Patreon. You can support us via our affiliate links at Amazon or eBay, or Independent Reserve and Kucoin. You can buy our merch from HeiseSays, use gold from Gold Pass, or support us via PayPal. Take care, everyone.